In today's video, we are going to look at Introduction to Accounting, and the topic is Principles of Double Entry System of Bookkeeping. Principles of Double Entry System of Bookkeeping. When we talk about Principles of Double Entry System of Bookkeeping, it was introduced by Luca Pacioli. He was the first person that introduced Principles of Double Entry, and the emphasis of the principle is there should be two accounts, the receiver account and the giver account. The receiver account and the giver account. The account that receives should be debited, and the account that gives should be what? Credited. And in Principles of Double Entry, when we're talking about double entry, it means posting into ledger. And ledger is the principal book of account. You know, there are two books of account. We have the subsidiary books of account, which are also referred to as the prime books of account, and then you also have the principal books of account, which we refer to them as the ledger. So today, I want us to understand how we are going to post into the ledger account, which is the principal book of account. And the ledger has two sides, which is the debit side and the credit side. The debit side and the credit side. And then the debit, what do you mean by debit? Because what is most confusing to learners is to understand what is debit and credit. Debit and credit is referred to as the language of accounting. Language of accounting. Why? It is language of accounting because if you are able to understand what is debit and credit, you have the basic foundation in accounting, which is like the foundation of the whole financial accounting, because almost all the topics are centered on how to debit and credit in the ledger or in the journal. So today we are going to see how we are going to post into ledger in using debit and credit. Then what is debit? Debit. When we talk of debit simply means posting or recording a transaction in the left hand side of the ledger. In the left hand side of the ledger. Why? Credit means posting a transaction or recording a transaction or an account in the right hand side of the ledger. So this is left hand side of the ledger and then the right hand side of the ledger. Then there are two illustrations I'm going to use to explain how we are going to debit in the ledger and then credit in the ledger, which is what is called double entry, because every transaction there must be debited. In every account or transaction that happen in the business, it must be debited and credited in two separate ledger accounts, and that is what is called double entry. Let's quickly look at the first transaction where we have on the 2nd of April 2026 bought furniture by cash 10,000. From this transaction, you must think which account is going to be debited and which account is going to be what? Credited, using double entry. And double entry have principle. The principle simply means debit the account that receives and credit the account that gives. That is the first fundamental principle of double entry. What the supporting principle say, any debit entry must have a corresponding credit entry. That is the principle we're going to use to post transaction into the ledger account, debit the account that receive, and then credit the account that gives. That is what we are going to use to post this transaction. Let's look at it now. Bought furniture by cash 10,000. In this account, there are two accounts. In this transaction, I mean to say there are two accounts: the account that gives and the account that receives. Here we look at cash as the account that gives, while furniture is the account that receives. How do you understand this? We are trying to understand that if a business or an individual want to purchase furniture by cash, it means the business is going to give out cash. I say the giver account is the account that gives, and that's the account you are going to credit. Then it means you are going to give out cash. You are going to give out cash. Then as you give out cash, you are going to receive something, and what you receive becomes the giver account. In this case, what you receive is the furniture. So cash becomes the giver account, and then furniture becomes the receiver account. Therefore, you are going to credit cash. Let's credit cash here as the giver account. They now say on the 2nd of April 26, cash is a giver account. We are crediting based on the principle of accounting. Now say cash is given to what? We now say cash is given to the receiver account. Then the receiver account here is furniture. Is furniture. And how much is the amount? Is 10,000. You can see that cash has been credited, means It is the account that gives. They will now go to furniture. Furniture is a receiver account. And in this case, furniture will be debited based on the fundamental principle of double entry. And here you come and say, on the same date, which is on the 2nd of April 26, furniture as a receiver account is receiving from cash, which is a giver account. And how much is that? It's 10,000. In this case, you understand that the giver account, which is cash, is credited, and the receiver account, which is furniture, is what? Debited. Just like that. If you are able to understand that, in every transaction you reason in that direction. Let's look at the second transaction using the principle. The second one says that on the 3rd of April 26, bought goods by cash 5,000. I want to clarify something here. Here we are saying bought goods. Here still the giver account is cash and the receiver account is goods. But in accounting, if you now say bought goods and you open goods account, it will not be correct. It will not be correct because in accounting, the goods that are purchased for sale are called purchases. So instead of opening goods account, which is somehow correct to a layman, you don't open a goods account. You open what is called purchases. Purchases because in business, the goods that are meant to resell, that is the goods that the business buy to resell, are called purchases. But in this case, you can look at the first transaction saying bought furniture. Furniture was purchased to use in the business to run the day-to-day activities for office use. So you are not selling this furniture, and that is why you cannot use purchases here. But here we are going to use purchases because these goods purchased here are made to resell them so that the business will get revenue. That is why we are not going to use furniture here. So in this case, furniture is not involved in this account, but we have cash account and then purchases account. Then here, cash is still the giver account. Then we will have to come upon record the cash account. I want to warn you that you are not going to open another cash account. Don't open it because the cash ledger account is already here. Make use of it. Then we are coming to record in the giver account. Now let's say on the 3rd of April 26, the giver account is still cash. This time around is giving to purchases. Don't say giving to goods. We know that it's goods, but as I say, goods here are referred to as purchases in accounting or in business, as the case may be. So we now say cash is given to purchases. How much is that? It is 5,000 naira. 5,000 naira. Then you now go and open purchases account. They come and open your purchases account, and then I say this is purchases account. In the purchase account, also you have your debit and credit. Make sure you put your naira sign because this accounting majored in monetary terms. They will now say that here, purchase account become the receiver account because as you give cash, you are able to receive goods, and goods become the receiver account, and then we qualify using purchases account. Then in this case, we now say on this fateful day, which is 3rd of April 26, purchases, which is the receiver account, is receiving from cash that was given to get the goods. And how much is that? Is 5,000 naira. So you can understand that here, purchases have been credited in cash because cash is given to purchases, while purchases is receiving from what? Cash. Now I hope you can appreciate that we have used the principle of double entry, which I say debit the receiver account and credit the giver account, and we are able to post these two transactions correctly into the ledger account. And then the second principle I want to explain that says any debit entry must have a corresponding credit entry. Let's look at the first one. In accounting, this is what's referred to as an entry. What you post here, the date, the particular, the amount, now become what is called an entry. So this is the debit entry. Then coming here, you can see the corresponding credit entry here. This corresponding credit entry. So this is entry 1 and this is entry 2. And that's what I say is double. Because the same transaction will be recorded in the debit side of furniture account and the credit side of furniture account. Then this becomes double entry. Then the second one you can see that purchases have been debited. This is entry 1, and then the same transaction have been credited in cash account, then this also become entry what? 2. So in this case, discover that this is entry 1 and this entry 2, then this become what is called double entry system of bookkeeping. Keep it. We continue in the next class. Thank you.